Alright folks, let's dive into the fascinating world of repo rates and how they affect the economy and your stock portfolio. Sounds complicated? Stick with me, I'll break it down. First off, what is a repo rate? Simply put, the repo rate is the interest rate at which a country's central bank lends money to commercial banks. It's short for repurchase agreement rate. Think of it as the cost of borrowing money for the banks. When banks need cash, they go to the central bank, borrow the money, and agree to buy back their securities at a later date, hence the term repo. Now, how does a change in the repo rate affect you and the economy? Imagine the central bank decides to increase the repo rate. This means it's now more expensive for commercial banks to borrow money. In response, these banks will hike up the interest rates on loans and mortgages to cover their costs. Higher interest rates mean higher borrowing costs for businesses and individuals, so businesses might delay expansion plans and consumers might think twice before taking out a loan for that new car or house. Conversely, if the central bank lowers the repo rate, borrowing becomes cheaper for banks. They in turn lower interest rates on loans and mortgages. This encourages businesses to invest and expand and consumers to spend more freely, boosting economic activity. But wait, what about the stock market? Here's the connection. When the repo rate is high and borrowing costs are up, companies have less capital to invest in growth and expansion. Investors, anticipating slower earnings growth, might sell off stocks, leading to a drop in stock prices. On the flip side, when the repo rate is low, borrowing is cheaper. Companies can invest more in growth, which boosts their projected earnings. Investors see this as a positive sign and start buying stocks, driving up the market. It's important to remember though that the repo rate is just one piece of the puzzle. The stock market is influenced by a multitude of factors, including global events, corporate earnings reports, and investor sentiment. So next time you hear about a repo rate change, you'll know what it means for the economy and your investments. It's a powerful tool that central banks use to control inflation, stimulate growth, and ultimately influence the stock market. Alright, that's a wrap for today. If you found this video helpful, don't forget to hit the like button and subscribe for more insights. Thanks for watching. Catch you in the next one.